everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 90. This one is titled Entering a Collar Trade. We're going to be using a real-life example with iShares Silver Trust, which trades on the New York Stock Exchange under the ticker symbol SLV. Well, let's get this podcast rolling with a definition of what is a collar trade. Now, there are three legs to a collar trade. First of all, we buy a stock, so along the stock. And we buy shares in 100 share increments because for every one options contract that we sell, we must first own 100 shares of the underlying security in order to be covered. Now, of course, we screen for stocks that meet our system criteria. So in the BCI methodology, we screen from a fundamental, technical, and common sense perspectives, all three. So the first leg is the stock. Now, the second leg is the call option. So we sell an out-of-the-money call option priced higher than current market value, and that will generate premium, which is really what this is all about. Now, the call option strike price represents the ceiling of the trade. We can't make any more money on the stock over and above the call strike price. So the second leg of the collar trade is the call option. The third leg is the put option. In this case, we buy an out-of-the-money put option. Now, for puts, out of the money is lower than current market value, and that gives us protection to the downside. So this represents the floor of the trade. So once again, the three legs are the stock, the call option, which is sold, and the put option, which is purchased. Now, what is the rationale for structuring of a collar trade? Well, first of all, why are we doing this? We're doing this to generate cash flow. We're looking to make money, pure and simple. So we use the stock to leverage the option premium in order to generate this option premium. Now, we must have an option credit, a net option credit, in order to make money. So that means that the cash we generate from the sale of the call option must be greater than the debit created when we purchase the put option. So the call premium must be greater than the put cost to purchase. Now, we must first define what our initial time value return goal range is, and we base that on what we're looking for when we're doing a covered call writing trade. In my case, I look to get 2 to 4% a month for my initial 1 month time value return goal range. And in a very strong bull market, I'll go up to 6%, but never higher, because higher premiums would result in greater risk. So that's what my defined range is for covered call writing. Now, when we use a collar trade, we're also purchasing put options. So that means that our net time value is going to go down. How much? Let's use as a guideline half. So our initial time value return goal range for collar trades would then become 1 to 2% a month and up to 3% in a bull market, approximately half that of our covered call writing goal. Now let's turn to a real life example with SLV. And on 8/5/2020, SLV was trading at $24.99. That is our long stock position, in this case, an exchange traded fund. Now, as soon as we purchase the shares, we then sell the out-of-the-money covered call. Well, it's only out of the money by a penny because we went with the 25 strike. So it's kind of near the money, almost at the money, but slightly out of the money. And we did this for the expiration of 8/21. So it's about a 17-day trade. And it generated $1.34. That represents our ceiling because we're obligated to sell our shares at 25 when they were trading at market at 24.99. Now, also at the very next step, we then purchase an out-of-the-money protective put, in this case for the 23 out of the money put strike. And that costs 48 cents. So is the call premium of $1.34 greater than the cost of the put, 48 cents? Yes, it is. So the floor is the 23 strike on the put, and the ceiling is the 25 strike on the call. And that's how the trade is structured. Now, for those of you watching this podcast, I am now showing you a chart. I'll describe it for those of you who are just listening to the podcast. It shows that SLV was an uptrending stock since July of 2020 and uptrending significantly. When the trade was entered, the red arrow for those of you watching this podcast, then SLV continued to appreciate in value and then started moving sideways. So it shows a bullish chart, and that's one of the reasons why SLV was selected for this collar trade, put sale, for the call sale rather, and the put purchase. So it had a very nice bullish price chart. So the next step is to feed this information into the BCI Collar Calculator. And we enter the information into the white cells at the top of the spreadsheet where SLV was trading at $24.99 and the out of the money call, 25 call, generated $1.34 and the out of the money put cost 48 cents. So that information from the option chains is placed into the white cells of the BCI Collar Calculator, and the calculator gives us the following results. The initial return is 3.44%. Now, we said we're looking for 1 to 3%, so we're kind of on the outer edge of that. Now, if the price of the stock moves up to the call strike, that's only by a penny or beyond, then the return moves from 3.44 up to 3.48. Not much of a difference there because, as I said, it's a near the money, almost at the money call strike. Now, what if SLV moves down below the floor, the 23 put strike? Well, the maximum loss there would be 4.52%. So we're going to end up anywhere between a gain of 3.44 and a loss of 4.52%. And that's a very reasonable risk to take on a stock or an ETF that has a very bullish price chart and also a security that we've screened from a fundamental perspective as well. And remember, this is only a 16-day return. So the 3% better than 3% is actually way better than if we were doing a full month. So it shows you that the SLV has a fairly decent implied volatility to it, but a trade that ended up on the positive side because for those of you who took a look at that price chart that I showed before, or those of you listening, you could just take my word that SLV continued to go higher after this trade was entered. So let's summarize now. Collar trades need to be structured so that they generate cash flow. That means a net option credit. The call premium generated from the sale of the call must be greater than the put premium that costs us to purchase the protected put. And the initial time value return goal range typically would be lower than that of our covered call writing trades because of the fact that we also have a debit on the put side, which we don't have with a traditional covered call writing trade. And as a guideline, we look to generate at least 1/2 of what our traditional covered call writing initial time value return goal range is. So before I go, I just want to remind you to visit the bluecollarinvestor.com website. Remember to type in THE for thebluecollarinvestor.com. We have some free resources for you at the top black bar, which includes several calculators and files and such. We also have a free beginner's tutorial for both covered call writing and selling cash secured puts, where you can download the PowerPoint slides, all for free. And I want to remind you also about our best package the BCI package, we call it, and that's an acronym for Best and Most Comprehensive Investment Package ever offered by the blue collar investor. So just click on that BCI package link, have a look, all the information is there, plus a video that explains all of the products included in that package, which is discounted 20% if purchased as a package. So all that on thebluecollarinvestor.com website. Okay, so that ends BCI podcast number 90. I want to thank you all for taking the time to listen to and or watch this podcast, Entering a Collar Trade. Folks, I hope you enjoyed this presentation, and more importantly, I hope it put some cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.